Now let's begin with an introduction of the financial concepts. First of all, before diving deep into the financial concepts, let's understand a short description of what is a project manager first of all. Who is a project manager? When do you define yourself as a project manager? What are your roles and responsibilities? What are your liabilities for being a project manager? And stuff like that. So that gives you a brief insight into the life of a project manager, and then you can take a much better effective decisions as to what financial implications you need to be analyzing as a project manager. So let's begin. First of all, let's answer the simple question, who is a project manager? Oh, I beg your pardon for my grammatical mistake over here. It's supposed to be who are project managers or who is a project manager. Okay, coming back to the subject, guys. A project manager is simply any person who has been given a charge of a project. Okay, he is responsible, he is in charge of a particular project. Now that project can be in terms of anything. It can be a financial project, non-financial project, any kind of project. But always remember this one thing, whatever the project will be, it will always have a financial implications. It can be a non-financial project like, brand advertising, launching a marketing campaign and so on. But the end goal is always to generate revenues, profits and all, and it ties back to the financial implications. Okay, so the project manager simply is a person who is given a charge of a project. That's one thing. Now, he is also the guy, or you can say with this charge, with his responsibilities comes a lot of factors. He's accountable for a lot of things. He is responsible for the successful initiation of the project, successful planning, design, execution, monitoring, controlling, also closure of the project. A project cannot be open till infinite time. There is always supposed to be a due date, a closure date. Now, the project manager is responsible for making sure the project closes on time. The output is delivered to the client or the company or whoever is working on time. Now, making sure it has been contributing positive results to the organization, both in terms of financial aspects, that is measured by way of profitability, positive cash flows, as well as in terms of non-financial aspects. If the project has another KPI, or you can say key performance indicator in terms of non-financial aspects, that can be by way of a brand image building, increase customer satisfaction, reduce customer complaints, anything. So to give in a nutshell, a person can have any kind of activity as a project and is responsible for starting till the end of the project, also making sure he achieves the objectives with which the project was launched. Next we come is the roles and responsibilities of project manager. Now the project manager's primary responsibility, the primary duty is recognition of the risk that directly impacts the likelihood of the success of a project, and that risk must be both formally and informally measured throughout the lifetime of a project. So what do you mean by formally and informally? Formally means, documenting every evidence that this is the risk which is going to come in, this is the risk which can going to come in. Like you can say a recent change in government policies might make the entire project obsolete, so he has to document that thing formally. Informal risk can be, you can say, if he has got some news by way of the gossips around the corner or grapevine communications that some XYZ competitor is going to launch a similar campaign in the next a week before he plans to launch the product campaign. That is an informal way of documenting the informal measure of a threat to a project, informal risk to a project. Those all the things he needs to consider because they all have a likelihood or they all have a possibility of impacting his work. Okay. Now, to put in a nutshell, the responsibility of project manager can be many activities, some of which are like planning and defining the scope of the project and the activities to be performed, actively planning and sequencing of the activities to be performed, resource planning, time estimations and preparing the schedules of the project, developing the budget for the project, preparing forecast, actively keeping a track on the project, documentation of the progress and important events for the future references. This is also one of the key aspects. Most of the time people forget to document the various steps they have taken, the various challenges they faced in the project, the various milestones they hit, when did they hit, what steps did they take to overcome the challenges and so on. If the documentation is readily available, if the project is repeated in the future, that can serve as a reference guide for himself if he's taking the project again or to anyone who is going to come up in his place and take up the project. Next, he's also need to be aware of the risk analysis, managing the risk, that is a SWOT analysis, strength, weakness, opportunity, threat kind of a thing for his own project. Risk analysis, monitoring, reporting progresses, team leadership, strategic influencing, vendor relationship management, quality control, and whatnot. You name it and it can come up. So you can say the project itself can run as an entire organization activity, where everything that is possible for the organization can be possible for a project manager also, because he's performing a part of the organization's core role. With that, we come to the next part, that is liabilities of a project manager. Now, the project manager, as we have been emphasizing, is responsible for the entire execution to the completion of the project, initiation till the completion of a project. But now let's look at a deeper way. What is a liability project manager? Now, the project manager is responsible to make sure that his entire project is completed within the estimated budgets and the other guidance and company standards are adhered to. Obviously, every company has their own set of standards, their own set of policies, their own set of rules and regulations. So, the project manager needs to make sure that he completes the project within the budget allocated to him and also following the company standards, rules, regulations, so that company's image is not shattered by any of by him going out of the way. Even if he has to go make an exception, make sure you communicate with your top management, you speak up to your seniors who are involved in the project, your management team, and only after cautious approval go ahead with that, with that exception. But most of the time it's not required, because companies who are authorizing the project, they do know what challenges can come up, because already most of the projects will have been done in the past with the companies. Even if they are not done, if it's a one-off thing, it's a new thing, they'll still have, you can say, people are much experienced to evaluate what are the various pros and cons, whereas possibilities, probable possibilities that can come up in the project, and so on. Now, if any targets or deadlines are missed, then it is a project manager's liability to make up for the additional cost unless it was something beyond his control. So you can say, in a way, if the project manager knew that the cost can exceed because of a certain risk and he did not take up the adequate steps to mitigate that risk, it is obviously his liability. He is liable for the entire additional cost incurred by the company, additional loss of revenue by the company, and so on. But if it's something which is not in his control, like we said, if a company wants to do a marketing campaign by Facebook, Twitter, and suddenly government comes up with a rule that social media handles are no more allowed to be used in a digital marketing, bang, the whole project is screwed up. But that's nothing beyond it, nothing in its control. The project manager cannot control that campaign, that government's outcome. So those are the factors which needs to be considered, and accordingly he is made liable for those things. If it is in his control, he needs to make sure he takes adequate steps to mitigate the risk, to make sure projects are complete on deadline, to make sure they can be complete before the deadline, and makes the company a good amount of profit in terms of financial aspect as well as non-financial aspects also. Profit in terms of financial aspects, I believe we all understand: gross profit, net profit, increased revenue, cash flows, and so on. Non-financial aspects: increased customer satisfaction, reduced customer complaints, positive brand image for the company, and so on. Now, even though there will be technical challenges in completing the projects, which are justified many a times, it may happen that the project manager is not able to defend himself. The primary reason being that the project manager in most of the cases do not have a financial expertise. Okay, sometimes even the basic financial knowledge is lacking on their part. They might be experts in their field, they might have the whole Wikipedia published in their minds on the particular field in which they are working. It can be in terms of marketing, IT, web application development, mobile application, and so on. But because of this lack of the financial knowledge, sometimes they screw up on very badly. And the top management, or you can say the management, is mainly concerned with achievement of the numbers in most of the cases, while this guys, whenever the management approves the project, the end goal that they have in mind will always tie back to any sort of profit for the company. It can be in terms of financial measures and non-financial. Even if they are targeting a non-financial achievement, it all ties back to a financial number only. Think of this thing. Why does the company want to take a project which is increasing their brand reputation, which is reducing their customer complaints, which is increasing their customer satisfaction, all just to pump up the sales number, all to derive a new revenue streams, all to get the customers' loyalty so that more sales can happen, ultimately all tying back to increasing profit for the company, right? So coming back to the point, so it happens that many times the technical experts are not able to justify the delays or additional costs involved for the project, and so on. Besides, precisely, they are not able to defend themselves when any kind of delay happens in the project. And because top management, or you can see the management, is mostly concerned with numbers, and these guys don't have the expertise, it becomes a real challenge for the project managers to defend themselves, to justify themselves. In that case, having a basic knowledge of the financial concepts helps the project managers go way beyond and defend themselves properly. Not only defend themselves, but give proactive suggestions, give proactive reports and analysis that this is why the project should make sense to you company and we should carry on. It's all a bit boring theory right now. I get the point, guys. Hold on a while. This lesson, once we complete this introduction to financial concepts, it's all going to be fun, the numbers and analysis, and you're going to love that thing. But before that, we need to understand what is the importance of this thing. Now, till now, whatever we have studied or whatever we have gone through, based on this, we can conclude that everybody, whether belonging from the accounts and finance background or not, he is going to manage a project at some point of time in their career. Okay, now everyone is going to manage a project at some point of time in their career. They will have their own team members, they'll have their own team, they'll be a team leaders, they'll report to someone, and it's going to happen. You will take up a project in your life irrespective of the fact you know it or you don't, but every project involves a cost on which a return is expected. Now, it is hard for the project managers from non-financial background to evaluate the financial progress of their projects and take corrective actions before it's too late in some cases, right? So, therefore, this course will help you in gaining that basic financial knowledge, and it will provide you, and I'll make sure that it provides you the tools and methods you need to evaluate the progress of your project. At least in terms of the financial experts, because that's where my domain lies, that's where my expertise lies. I'm not from a non-financial background. I have expertise only in the financial aspects and the accounting aspects. If you ask me, to be honest, what does digital marketing campaign and all mean, I'll be like completely blank because it's never done, tried out. But yes, I can evaluate the financial aspects of that, and that's why I'm trying to share my knowledge and get you up and running to some speed. Now, with this, we complete the whole understanding of the project manager. What are the roles and responsibilities, what are the liabilities, and how everybody is going to be taking up a project at some point of time in their career. And this course will help you to be ready beforehand, before you at least start a project, or even if you are having a project or you have already been doing the projects. I'll make sure you get some useful benefits by studying this course and understanding how to imply those concepts in your actual ongoing project. And for those of you who have not started a project, this is a golden opportunity for you to learn to manage a project, at least in terms of financial and accounting aspects, so that you are more ready. Imagine this thing: your technical expertise plus the financial knowledge, combining the two different domains, that will give you a cutting edge in being a project manager. I'll see you in the next session, where we're going to start with the financial concepts actually now. Now we'll begin our understanding with what is a financial statement. So before we go into the depth of understanding what statements or what reporting statements comprise of financial statements, let us understand what is a financial statement basically first. In a simple layman term, you can say financial statements are those statements which contain the financial information about an organization. Now, the financial statements, they are the primary means of communicating financial information to the users of the financial statement. And the users can be an external user as well as internal user. We're going to come that in a couple of minutes from now and understand who are external users and who are internal users, from what point of view both of them are going to be studying the financial statements. But as of now, understand this thing: the financial statements, they are the primary means of communicating the financial information to external as well as its internal users. Additional information that is not provided in the financial statements, that cannot be quoted in number format, that cannot be given in the financial statements, they are given as a note format, a financial statement notes. Supplementary information are also included in the financial statement, such as management discussion and analysis, other disclosures that are typically disclosed in the notes, which are essential to understand the financial statements, and so on. So that is the purpose of financial statement. In short, to communicate the financial information of an entity to its users, and the users can be external as well as internal users. A full set of financial statement comprises of a statement of financial position called as a balance sheet, income statement known as a profit and loss statement, statement of comprehensive income. The statement of comprehensive income includes all those income and expense figures which cannot be put in the profit and loss statement, that is your income statement. Statement of changes in equity, that is the owner's money. Okay, what is the change in the owner's money, owner's equity since beginning of the year at the close of the reporting period. Next is statement of cash flows, and lastly notes to financial statement. Together, these 6 things comprise a full set of financial statement. I'll repeat those 6 elements or 6 statements once again. Statement of financial position, also called as balance sheet, income statement, also known as profit and loss statement, statement of comprehensive income, statement of changes in equity, statement of cash flow, and lastly notes to the financial statement. However, from a project management perspective, you only need to be aware of 3 key statements, which are balance sheet, profit and loss, and a cash flow statement. Balance sheet will represent the assets and liabilities. Okay, how much the company owns in terms of assets, how much is company liable to pay to the external parties, what is the owner's equity in that. Profit and loss statement, income earned for the period, expense incurred to the period, net result, whether the income earned is higher compared to the expense incurred, Are we in a profitable stage? Whether the expense incurred is higher compared to the income earned? Are we in a loss-making stage? And lastly, cash flow. At what point of time cash is expected to come in, expected to go out, and so on. But three key statements are required to be understood from a project manager perspective. Balance sheet, that is also known as statement of financial position. Income statement, that is also known as profit and loss statement. And lastly, statement of cash flow. So these were the three key statements which we need to be aware of and which we're going to study in depth in a couple of minutes from now. Before that, let's understand who are the users of financial statements. So as we just discussed a couple of minutes ago, there are two users, external and internal. The external users are the one who are interested in doing business with the organization, and use of these financial statements will help them evaluate whether they should be going ahead with the doing business with the organization, whether it's beneficial for them to do business with the organization or not. For instance, your investors, the company's investors are external parties who need the information to decide whether to increase, decrease, or invest in a firm, okay? Or even sometimes to decide whether to take the investment from the firm. The creditors of the company, they need information to determine whether to extend a credit period to the company, organization, under what terms to provide the credit, for how much period of time to provide the credit. The financial advisors and analysts who need the financial statements of the organization to help their investors evaluate a particular investment. You know, when the financial analysts and advisors, they take up the company's financial statement, they study, they do the complete postmortem of the financial statements and come up with useful relationships, meaningful data that they give to the investors readily, and based on which the investors decide whether they should invest in a particular company or not. Also, the stock exchanges need financial statements, okay? Yes, you heard right. The stock exchanges need the financial statements to evaluate whether to accept a firm's stock for listing on the stock exchange or to suspend the stock tradings or not. So basically, all the compliances flaw, the stock exchange also determines the compliances flaw from your financial statements. That's why it's mandatory for a publicly listed companies to upload their financial statements with the various regulatory authorities at least every quarter. There are different laws and compliances, but let's not get into the depth of this whole scenario, or else it will be a never-ending session for us. But I hope you got the basic gist that external parties are all those ones who are interested in knowing the financial status of the company to decide to make their own decisions, whether to invest in the company, whether to trade with the company, whether the company is complying with the applicable rules and laws, whether to trade the stock of the company, whether to suspend the stock of the company, and so on. Next, we come to the internal users. Now, the internal users, they are the one who use the financial statements to make decisions that are going to affect the day-to-day operations of the business. Okay, they are basically the persons who are within the organization who are going to use the financial statements. Let's say, for example, management. Management needs the financial statements to assess their financial strength and their deficiencies, to evaluate the past results and decide on the future course of action. Okay, what steps, how well have they performed in the past, how well are they able to meet their expected budgets and develop the future course of action? Do they need to raise the bars, challenge higher themselves, or are they underperforming, so they need to take precautionary measures, active measures to make sure they are at least meeting the budget, the targets which they are setting for themselves. Next is the employees. Yes, now if you're wondering why will the employees want the financial information, they do need. Employees want the financial information to negotiate their wages, their fringe benefits based on the increased productivity and the value they are providing to the company. So let's say if the company is keeping on generating more and more profit, but employees are not getting any raises, any pay increment in the paychecks. Obviously, employees will want to determine how well is the company performing and why are their promotions and appraisals not happening as compared to the increase in the productivity, in the value which they are generating to the company. And how can they measure the value they are generating, the value they are providing to the company? The first means will be a reflection on the financial statements. If the company's profit are increasing drastically day by day, it's obvious that the company employees are doing a great job day by day. But if they are not being appraised, appraisals are not happening, if they're not being provided promotions and respective pays, they will figure out that their market value, their value is not being considered by the organization as much as they should. And that's why they also need the financial information. So with this thing in mind, with this background, I hope you got a clarity on what is a financial statement, what statement comprises of financial statements, and who are the users of financial statements. Once again, a complete set of financial statement comprises of 6 elements. Number 1, statement of financial position, also known as balance sheet. Number 2, income statement, also known as profit and loss statement. Number 3, statement of comprehensive income. Number 4, statement of changes in equity. Number 5, statement of cash flows. Number 6, note to the financial statement. But from a project manager's perspective, at least if you are belonging to a non-financial background, you need to be aware of at least 3 financial statements, at least 3 elements of the financial statements, at least 3 components. Number 1, statement of financial position, also known as balance sheet. Number 2, the income statement, also known as profit and loss statement. And number 3, statement of cash flows. Now, with this thing, we end a concept of financial statements introduction. Now, with the understanding of the financial statements in mind, what comprises of financial statements, who are its users, in that in mind, we're going to see what are the objectives of creating a financial statement. Okay, why is it so important for entities to create financial statements project-wise from the entity's perspective, as well as what are the benefits a project manager can derive by understanding the financial statements, how they work, how are they evaluated, and so on. So first, look at it from the entity's perspective, for the company's perspective. What are the objectives of creating the financial statements for individual projects, for the organization as a whole, for the company as a whole? First is they are able to track the ongoing projects on a real-time basis. So if the financial statements are being prepared on a regular basis, say every weekly, every 15 days, every month at least, so the company gets an insight into the individual projects going on a real-time basis. Any organization will not have just one project to be carried out at one point of time. They will be having a multiple project sequence going on simultaneously. Hence, it is important for the company to know, at least get a key insights into how each project is performing, and then take the future decisions with that regard. Next is determining if the project is meeting the standard returns. Okay, by standard returns, we don't mean the market standard returns, we mean the standard set by the company. So what is basically standard returns? Let's say government tax risk-free bonds gives a standard return of 6%. Okay, that is, you invest in your fixed deposit, your government bonds, and you're able to get a 6% return on that investment without any risk. You have a portfolio where your portfolio manager is able to derive a return of 15%. That is, by investing the various surplus cash in stocks and shares of other companies, by doing the bond tradings and all, he's able to give the company a rate of 15% annually. Now, if the project on hand is generating just a return of 12%, higher than the risk-free return, but lesser than the portfolio manager's optimum return, do you think, does it make sense for the organization as a whole, as from the point of the organization, to invest in the project which is giving just 12% returns? No, right? Because they will say, when the funds can generate a return of 15%, why should we invest in 12%? Unless there's some intangible benefit which is being proved, it's mostly rarely going to be happening, right? So you get the point. I hope you get the point that the company needs to determine whether the project are meeting their individual standard returns, their standard returns. If no, they need to divert their resources for a better utilization, for a better opportunities. Forecasting the outcome of the project. Okay, by forecasting the outcome of the project, we mean that if we have a continuous real-time data, and if suddenly the environment in which the project is operating changes, like some new regulation comes into picture, suddenly a new competitor comes and launches a similar product on which the company is already working. Here, the company can quickly take a decision whether to divert the resources from the existing project, whether to deploy more resource on the existing project, and such actions which will not only help the project manager but the entity as a whole to make sure the project is going to give the maximum return it can in the future when the project is completed. Divert resource from existing low return to high return projects. Let's say a company is having an ongoing project which is still going to take a sufficient amount of resources to be deployed to generate a return of 18%, and the company founds a new project, a new venture in which it needs to just invest half the amount of the project and generate a return of 25%. So here the company needs to think about whether to go ahead with the existing project or to divert the resources in the new project. If the existing project does not have a great bright future, promising future, the company will definitely put it in the new project, because the higher return, because of the higher utilization of the resources, better utilization of the resources, the higher return, and so on. So shutting down the existing low return project does make sense for the company. Let us say, we'll continue the previous example of the forecast one. A company is already developing its unique prototype product in which it has invested $1 million till now. It's expecting to realize a revenue, or you can say a return of 17% on the entire $1 million, but with the condition that it needs to invest additional $500,000. And here the company finds another opportunity where they can just invest $500,000 and generate a return of at least 25%. What do you think the company is going to invest in? It does make sense from the financial perspective to invest, from the organization as a whole to invest in the new project, because that's more promising, has half the, literally one third of the investment cost, and gives much more higher return. So those are the decisions which the company can quickly take if it has a real-time financial statement prepared, or you can say these are the objectives for preparing a financial statement for individual project-wise for the organization. And lastly, identify the key performance across various projects. So over here, the intention is not to eliminate the low performers, but to identify the key performers who are performing at their peak capacity in any projects, and adopt their best practices, adopt their strategies, and apply it to the other projects being taken on within the organization, so that every project can perform to its peak capacity, to its highest capacity. Obviously, sometimes the intention of the management goes in a negative direction, but if you are a project manager and not able to give the optimum return, the best performance, and you can see that some other guy in the company is performing to his, it's generating much more higher value for the company when the same project or different projects, it does make sense to know his strategy, his understanding of the project, adopt those practices for yourself, for your betterment at least. If your project catches up with the other projects, it's great. Even if it does not, you'll at least learn the best strategies for project management, for a real, how to, analyze the financial statements and prepare your financial statement for project as that, in that line. So those are the benefits which the organization can implement from its own side. Now let's look at the benefits of, or you can say the objectives of preparing financial statement project wise for the individual project managers. Okay, why is it so beneficial for the project managers to prepare the financial statements for their projects? So before that, I hope you understand this one thing. All these objectives are being diverted towards one single objective: enhancing profitability of the organization. So that's why it's very important for the project managers to understand how the various methods of tracking the performance of his projects are working, are functioning, so that he can make himself aware of those methods and educate himself, and make sure he presents the financial statement, he prepares the financial statements on his own end using those methods, and derive the following benefits. Take corrective action. By taking corrective action, we mean that taking corrective action before it's too late. Like one day you realize your project is not performing, your financial statistic of your project is not in a company's acceptable parameters, and they decide to shut down the project. Now suddenly you caught off guard because you were not prepared for those kind of answers. Had the project manager had the basic awareness of the financial statements, had he prepared those financial statements in line with the company is going to evaluate, he could have taken proactive measures initial itself and modified his project according to the needs of the situation, and made sure his project would have survived to the end with generating a great positive returns also. Explain the top management of the future course of action. Now, if the project manager is able to create his financial statements on a real-time basis, he has a much better insight into what's going on and what should the future course of action be, so that his project will achieve the expected returns and the objectives with which it was started will be accomplished for sure. Develop better forecast and budgets. If the project manager has a good understanding of developing financial concepts, he can develop a better forecast, a better budgets for the projects, and deploy his resources and time for achieving those budgets and give a good return to the company, thereby establishing his valuable credential as a project manager and setting an example for the whole company, as setting an example for his other project managers. Like we just discussed a couple of minutes back, the companies do take the high performing project managers and set an example, and try to publish their methods, strategies which they use to other project managers, so they can also be brought up to the speed. Lastly, they are able to project the existing project profitability by analyzing the project's ROI, return on investment, and this is a favorite computation for any analyst, any investor analyst in the whole world. So by this we mean that the project manager can himself evaluate how much amount has been invested so far in the project, how much cost has been invested, what is the expected return of the project, and are there any other opportunities which can generate the same ROI. So the project manager himself can go ahead and sell the company that, look, this is a new opportunity which I found. Compared to the existing projects, this project has a good amount of return on investment. If we divert our resources there, we have a beautiful, great outcome, and the management may appreciate that and take his decision. And thereby he sets himself a great credential that when time was right, he did not get too emotionally attached to his existing project. He was willing to drop it and take up the new opportunities which were benefiting the company as a whole, thereby not just satisfying your ego but thinking about the company as a whole. A project manager is able to establish his credibility, trustworthiness much more rather than sticking to the existing project which is not giving the optimum ROI, optimum return on investment as compared to the other projects in other opportunities available. So with this, I hope you have a clear understanding of what is the objective of preparing the financial statements for a project, individual projects. What are the benefits of a project managers to understand the financial statements, how he can take corrective course of actions, utilize better opportunities, hunt for better opportunities, utilize a better forecasting, prepare better budgets, and achieve his targets within the set timeframes, and thereby develop a good reputation, a good credibility for himself across the organization.